The S&P 2-week expected correction is probably over. We now recommend buying dips. Today is June 25th. The market has pretty much repeated the pattern that we put up last week, which basically showed the market would go down a few days, rally, and then potentially come down into the 26th. It may still do so. There's still a few days where it could pop back down. But we don't expect any major dips at this point. We think the market is very strong. The 8-month cycle, which we talked about last time, is dominating and guiding the market higher. We're looking for a rally into the middle to late August. And basically, we are looking for potentially a few more opportunities to buy until July 9th, because several other cycle lows come in between now and then. But the main idea is the market's fairly bullish. Now, we're not super bullish yet. We need to see prices above 63.50 and stabilize above that before we're willing to say the market's going to be a huge, explosive, ongoing type rally. Until we reach those levels, we can't say anything super bullish. And the momentum balance technique, which was calling for 61.50 a few weeks ago, is now calling for 63.50 as a target. And it usually does happen. It doesn't say when, by the way. It's not a time indicator. So there's a pretty good chance we will see that number. And what happens around that level is important. Now, we also said, and we continue to think, that after August, the market probably will have a correction. And it may have another high in September before going down hard into October, and then have a very strong rally late in the year. The 20-year cycle is still repeating, although the dip, the size of the decline, has been exactly in the right place in time, but it has not done it in price. Similarly, the 31-year cycle, 1994 market, also called for a big sharp break, and we didn't get the big sharp break, but it's happening at the same exact time. Both of them have a few days left where the market still could come down some, but it isn't likely to be as extreme as either of those markets. And what we do see in both of them, however, is after that, after this low, we would see a rally up into August or even potentially into September before a decent breakdown into early October. We are seeing also potentially at the end of the year another very large rally into 2026, into February or April of 2026. At this point, the bear has not shown its head. The 2001 market, which was a candidate, is still not shown up in terms of the price action is not repeating cleanly enough. It's still a small possibility that it is there, but not likely. Okay? And remember, what we have been teaching in our course is that the time value is the primary thing. And sometimes the time value will repeat the same level of price action, and sometimes it won't. But the time value will end when it ends, and the market will reverse when it ends. And right at the moment, even though we had a wimpy pullback here, 168 S&P points, when we were expecting larger, it doesn't mean that the market will do so. And you simply have to be flexible enough, either have a stop loss order in place, or be willing to get out of a potentially even a winning position with a small profit before the market reverses upward, and not hang on looking for bigger and bigger and bigger profits. It's very hard to predict both time and price exactly, particularly in a strong market, which has been in an uptrend, which is likely to continue for a few more months. It's kind of midstream. Those types of pullbacks are harder to gauge.